This is a video about the national housing market forecast for 2023, as well as the Houston real estate market forecast for 2023. So I'm going to dive into the national portion first, and then I'll get into the Houston area. So if you are out of the Houston area and want to know what's going on in real estate, take a look at this video in the first part, and then you can just move on when I get to the Houston area in case you're just interested. So, but with that, let's dive right into the numbers. Oh, sorry, I forgot. Before I dive into numbers, my name is Paul Holub with Keller Williams Realty in the Houston area, and I'm also a Ramsey trusted real estate agent, and I help people buy, sell, rent in the greater Houston area. All right, so first let's go over the national stats here for real estate. So the median national single-family sales price was $357,000 in 2021. This past year was $392,000, so that's an increase of just about 10%. So prices increased 10% nationally last year. Number of single-family homes sold was 5.4 million in 2021, and about 4.48 million in 2022. So we're down almost 21% year over year. So we had just a crazy increase in sales in the beginning of 2022, and then we just saw everything slow down and prices, sales were down for the latter half of the year. So that's not super surprising. All right, so months of supply nationally was 2.2 in 2021, and then increased to 2.7 in 2022, which is an increase of 13% year over year. So that's slowly increasing, more inventory coming in the market, which is great for home buyers. So new home starts is when the builders are starting a new home. Sounds simple enough. And in 2021, we had 1.6 million. In 2022, we had 1.55 million. And that's a decrease of 3.2%. And here finishing up the year, mortgage rates at the end of 2021 was 3.12. And then in 2022 was 6.27, which is an increase of 100%. That's kind of a quick recap here. Let's look a little bit at some of the projections for 2023. Home sales are expected to continue to fall 6.8%. So we fell 21%, so we're going to fall even a little further in home sales. And then as far as pricing goes, there's a lot of people making their projections. Let's look at the graph so you can see that a little bit better. And you can see this by the source, the Realtor.com, HPES, NAR, Freddie Mac, MBA, Mortgage Bankers Association, Freddie Mac, Zelman. They'll kind of have their own pricing. Realtor.com is the highest at 5.4%. All these Zelman's, I think it was a negative 4%. So if you average everything out, you come to about 0.1% for all of the pricing analysis. So I think prices are probably going to stay close to about the same. We did see it peak last year in May of 22, and then it's kind of falling back down, and I think it's going to kind of find a good leveling off plateau, so to speak, of where the prices were going to be nationally. So that'll be interesting to watch. And also another fun note is Pulsomics does a poll of over 100 industry experts. Not sure who that is, if they're economists or brokers or what, but they're calling for ongoing price appreciation from 2024 through 2026 of 2.6 to 4% annually. So I think with all the craziness, things are kind of leveling off from COVID, and then we will start to see the traditional 2 to 4% increase in pricing that we tend to see nationally. So we'll see what happens with that. But as far as prices goes, they're not expecting pricing to drop quite much at all. Number 3, mortgage rates are expected to finish around 5.7%. And I'll get into the graph in that in a second, but because that's definitely a big drop from where we are now. And then new home starts will be about 1.5 million new homes. First, let's look at closed home sales, and they fell the most in a largest record here in January, down 36% year over year. So home sales just dropped off in January, and as you can see, year over year, things are just declining. So we'll start to see it slow down. I bet it'll kind of come back up and then find a good leveling off spot closer to about 0% there. So that's going to be interesting to see. New home sales, 59% of new home builders have reported providing incentives to try to entice buyers to purchase a home. Incentives, again, could be a mortgage buy down, which are lowering your mortgage rates, price cuts, or adding more incentives like, hey, you get some free upgrades or more money to purchase an upgrade if you're buying a new home. So that's quite different from what we've seen, whereas like the builder would say, hey, the home's a home, take it or leave it, and you had to take it because there are people lined up way behind you for just in line to buy a new home. So it's definitely kind of seen a switch here in the market. Builders are still facing higher costs of building, still facing some labor shortages. Prices are down, but they're still up 14% from pre-COVID numbers. So with prices kind of starting to come down and demand's coming down, they are facing some of those other issues still. So it's just going to kind of see if the builders can kind of find a good stabilization where sales will be good, but it's just not going to be as great as it was in 21 and 22. So new home sales, if you look here by the year, we had just an increasing number of new home sales, and then COVID went crazy, and then now we've just been kind of downtrending from there. So we'll see if we kind of come back up and find a good leveling off space, or if we're kind of keep coming back down. So that remains to be seen here. But one thing is that the new builds are starting to keep up with population growth. The blue line is population growth from 2000 to 2020. And then these are the new homes built by the year. In this past couple years, we built 1.5, 1.6 million new homes nationally. So we should be right above the actual population growth, kind of help keep up. And Dr. Young, the economist for National Association of Realtors, says we build 1.5 million new homes or more each year, we will be able to, keep up with population growth, barring something crazy. So that's kind of about where we need to be. And so hopefully we can kind of keep up there and keep things going. And this too is a little bit older graph, but I just love it. You look at homes built by the decade. In the 70s, built 11 million. In the 80s, built 10 million. In the 90s, almost 11 million. 2000s, built 12 million. And then 2010s, we built 6.5 million new homes. We're all reeling from the 2008 crash. And so the builders definitely kind of are in a hole, and you can see that a little bit better here. This is the long-term average, and we have yet to, I guess we are meeting that in these past 2 years at 1.5 million new homes, but we have this big hole. So even if we do start to see more increases in inventory, we're still going to be under where we need to be as far as new homes being built in the U.S. nationally. So there's a couple factors impacting the real estate market right now. Obviously, I talked already about builders. The other thing too is that sellers are staying put. They've got 3.5% interest rate, and they don't really want 7% interest rate. So that's going to have a impact on inventory. Fewer people are going to put their home on the market because they're going to consider the interest rates like, no, I don't really want to deal with that. So I'm happy where I'm at. I want another bedroom, or want, a bigger backyard, or move around, maybe in the same neighborhood or whatnot. But I don't really want to handle that 7%, so I'm just going to kind of stay put. So that's going to further kind of depress home inventory and kind of, in a sense, recovery, where prices could come down if we had more inventory. But I definitely think that's going to help keep us in the lower inventory state this year, despite lower home sales. And according to Redfin, 85% of U.S. homeowners have a mortgage rate of 5% or less. So a lot of people are incentivized right now to move, as people kind of get used to like, hey, 6.5, maybe upper 5s, maybe low 7s. So it's kind of maybe about normal. It'll make, people more sense, and it'll be able to justify a little bit more as far as when they can make that move. But it's going to kind of take a while for people to kind of wrap their head around that. And I think we're starting to see that some buyers from last year, they're like, I don't want to deal with this. This is going to drop. It was because interest rates just shot up so fast last year. So we'll see how that impacts sellers this year. All right. Number 2 is low inventory. Again, because those sellers are reluctant to list their homes, we'll have lower inventory, low inventory, high prices, high inventory, low prices. It's kind of basically supply and demand. And then relatively high home prices. So we peaked again for the highest average sales price in May of last year, and been coming down since, but we're not that far off of, the highest we've ever had. And then I think there's some hidden demand. The market was so crazy last year in spring and in summer that if you weren't going 10, 20, 50 grand above the list price and waiving your appraisal and even sometimes your inspection period, then, a lot of times you didn't get a house, because it was just so competitive. And so I think a lot of buyers were disenfranchised and decided like, hey, I'm going to sit on the sidelines and just wait. We'll just see what happens. We'll buy next year. We'll rent another year or two. It's not that big a deal. So I think a lot of the buyers are going to start putting their toes in, and just to see like, is now a good time to buy? Is the market a little better? Just kind of get a better feel for things. So that is, it kind of remains to be seen. Like, what are those buyers that were on the sidelines last year? How are they going to respond to the new higher interest rates and the high prices? So let's look at home inventory here for the past couple of years, from 2020 through 2022 at the end there. So we are seeing that increase, from our lows in I think January, from February, March of 2022 to just increase quite dramatically in the 500,000 single family homes. So we'll see as it kind of comes down and then raise back up, or we're going to find a little plateau. We'll see. But again, more home inventory is great for home buyers, more options. All right, so this graph is a bit confusing, but it's the supply of homes available on the market. It's a 4-week rolling average. Here is the gray line is 2020, and then COVID hit and we just dropped. You know, the number of homes, the inventory just was super low. And then in 2022, we were even further depressed as far as the inventory, which just made prices go crazy. 2021. In 2022, we started out low and then just slowly increased as interest rates started going up. The market kind of started to like, hey, let's calm down just a little bit. What's going to happen? I'm not sure. And then so here we are in 2023, this orange line, that our inventory has gone back up almost to the point where it was pre-COVID in 2020. So we're pretty close to, you know, back to normal. We'll see how that goes the rest of the year. I definitely think we will be kind of right along here at this line. We won't be this low, but I think we will kind of stay, you know, 3.5 to 4 months of inventory, which is getting closer to more of an even market. Here's month supply of U.S. single family housing. The black line is the new homes, and then the blue line is existing homes or resale. So we are seeing more homes come on the market, particularly new homes, and that is great because the new homes are kind of like a bellwether for real estate. You know, as these new home prices go up, you know, it kind of tends to pull up somewhat the resale homes, and as they drop and have more inventory, you know, it tends to kind of lead into the resale homes where they have more inventory and prices drop a little bit. So it's a good kind of bellwether for real estate. So as we see more inventory come up and prices come down, we will start to see some of that within the resale market. All right, as you can see, this is a graph for the U.S. single family home sales. We've dropped quite a bunch from our peak up here to 7 million down to 4,290,000. And so we will see these come a little bit back up and then kind of plateau off. But for now, you know, home sales are definitely depressed. This is a fun graph. It kind of shows you the number of homes that had to reduce their price year over year. As you can see, last year prices, you know, homeowners had to start decreasing their home prices, which was something that they were not used to. They're used to increasing them for the past year and a half. So just kind of keep that in mind. As you know, I was telling my sellers in 2021 and half of 2022, as the market goes up, okay, maybe you can kind of price your home ahead of the market, and the market's going to kind of keep up to it. As the market goes down, you need to, you know, have your home priced at the market, maybe even slightly below it, so that, you know, if it does start to drop even more, you're not up here and then the market's dropped and like, okay, I'll do a price drop. And then, well, you still haven't quite hit where the market value is. And then it kind of keeps going. I don't think that's necessarily where the market will be this coming year, but I do think that that's a good thing to consider and keep in mind that you can't just kind of expect appreciation year over year just because your neighbor got it last year. So that's good to keep in mind. All right, and here's a graph based on percentage of homeowners that have, you know, percentage of their mortgage the rates. Again, about 85% of them are less than 5%. So there's just, you know, 15% of them higher than that. So there's a good portion of homeowners that are pretty happy, you know, because a lot of them are, again, less than 4%, you know, 65% of them are 4% or less. And so that's, you know, doesn't provide a lot of motivation for those homeowners to move. So I do think that there is not going to be a crash, but I do think there will be a little bit of a correction. So the COVID and everything was just so crazy, and the real estate kind of is slow and steady for the most part. So I do think we're going to come back down to more of a leveling off period, but that doesn't necessarily mean it's going to be a crash like a lot of people have been calling for. And a couple things that show this, or to my point, is that we don't have very many distressed properties at all. Foreclosures and short sales are, you know, here 2% of sales in November of 2022. There's practically no short sales and foreclosures. When I started in 2013, you know, it was about 25% of the market was, you know, distressed assets. So I had to learn how to do that. And then as we've gone into the market where there's none and a lot of people have a lot of equity, it just kind of changes the market a bit. So I think it's a completely different time from us coming out of 2008, the Great Recession there. Another thing too that helps to my point is that if foreclosures and bankruptcies are, you know, 2010 here so dramatically that just there's not as many people going into bankruptcy, which causes them to, you know, foreclose on their house or short sell it. So again, people are in a better situation than they were at the crash of 2008. Another thing too, just to not to belabor my point, but homeowner equity is the highest we've ever seen at 29 trillion, and the housing value's gone over 41 trillion, and obviously probably come down a little bit since then. But for the most part, most people have equity in their home, so that if they are in financial trouble, they usually can sell their house and have some equity to use to pay off debts and so forth. So this is a good thing that people do have that kind of equity. So let's talk about mortgage rates. Last year, the mortgage rates doubled. From January, we had 3.22%, all the way to the end of the year in December at 6.42%. So they doubled in a year, which is a crazy increase, and we haven't seen this in a long time. So it's really kind of shocked the buyers and a little bit of the market. And as far as projections, a lot of people are projecting the market interest rates to be around 6.5%. It slowly dropped to the low sixes through the rest of the year. And if you look at some projections here from Freddie Mac, Fannie Mae, Mortgage Bankers Association, National Association of Realtors, they're all kind of somewhat similar, but if you take an average of the all four, Q1 is about 6.35, Q2 low sixes, Q3 upper fives, and then Q4 about mid fives, so a little bit above mid fives there. And with the current banking issues and banks going under, there's a lot of uncertainty right now. They are again still projecting those interest rates to kind of come down a little bit, but again, no one knows. I mean, who could have seen them double in a year? But these are some great projections as far as what people are expecting at the end of this year. And I do think we'll see that a lot of fluctuations, a lot of volatility, but I bet you we will see some of these at some point in 2023. All right, so housing affordability. As interest rates have increased so much and prices are still near all-time highs, home buying just quite isn't that as affordable as it was in the past. As you can see last year, this is a graph of, if you were on the median income buying the medium priced home in the US, how much of your monthly payment would be going to housing? And this past year, that would be 49% at the peak. We've come down since, or probably come down a little bit more, but for the most part, I mean, that's a huge jump from a lot of the 2010s where we were, 25 to 30, maybe kind of over 33%. So just home affordability, it's much lower than it's been in previous years. All right, let's talk a little bit about rent and inflation. Rent growth is at the highest we've seen since the 80s. I think rents are starting to come down a little bit, but it's just been crazy the past couple years as far as how much rent has increased. And here is a look at the inflation rate by month here since 2020, and we've definitely popped a little bit back up here in February, so we'll see how it remains. But needless to say, we're still at a higher inflation rate than we're used to here in the U.S. in recent memory. And one interesting thing that I did some research into was that housing is about 43% of the consumer price index, and that's the index that they use to look at to see, hey, where is inflation going? Was it up and down? What are this basket of goods, and how are they changing? And housing again is about 43%, and I found out how they determine housing and housing increases is that they actually just call up homeowners and say, hey, how much do you think you could rent your house for? And and these people may or may not be landlords, many of them are not, and they may or may not know what their home could accurately rent for. And so it's just kind of an informal poll or survey that they do, and it's called the owner's equivalent rent. And one, that seems very inaccurate to me, and then two, it also lags the market by about 12 months. Real estate's kind of slow, but some people are still kind of getting a little bit higher rental rates right now. And so the market's going to be a little bit slower for that, to show that inflation is starting to come down. Real estate's just not going to react that quickly. The other problem too is as you increase interest rates to 7 and above, it also drives more people into renting, which also drives rental prices up. So if you are looking to lower inflation, and 43% of your CPI is based on rent, they need to find a good equilibrium where people say, hey, I can buy rather than just go to rent because it's just too expensive to buy a home right now. And so hopefully they kind of come down. And I'm not projecting or saying I know the right answer or the right equation, but I'm just saying that rent does have a big impact on the CPI, and we will see this to stay higher than expected for a long time, maybe next 6 to 12 months, just because of the way they calculate it. And also people are driven more into renting because of the higher mortgage rates. So definitely something to kind of keep in mind when you're looking at those inflation rates. And here is the monthly rent. According to rent.com, you kind of see prices have just gone up astronomically since 2020, and then they are starting to come down year over year. And according to redfin.com, median house hovers just under $2,000 annually in January of 2023. So again, prices are coming down, but they're not quite there yet. All right, so now let's dive into the Houston portion of the market forecast here for 2023. Again, if you're just interested in the national numbers, thank you so much for watching. Please feel free to subscribe, because from time to time I do updates on the national market as well as our local Houston market. But with that, let's dive right into it. All right, well, let's do a recap first of how the market did in 2022 versus 2021. In 2021, we had 106,000 single-family home sales. In 2022, we had 95,000, so quite a drop, about 11% here. In total property sales were 131 in 21 and 117 in 22. So again, almost an 11% drop for those townhomes, condos, and single-family properties. Total dollar volume was $46.5 billion. As compared to $45.6 billion, and that's a drop of about 2%. So we sold fewer homes, but obviously they're going to be a higher price because we only had a slight drop, 2% drop in the dollar volume. And single family average sales price in 21 was $376. This past year was $413. So that's a jump of almost 13% for the single family sales price. That's the average for the year. So that's a big jump, and one of the reasons why we've just saw so much in dollar volume sold. All right, let's look at some of the projections here that I had for 2022. I thought home sales would increase about 2.6% to about 109,000. We had 117,000. I thought prices would increase about 5.7%. They increased 10%. I thought the projected average rental would be about 2050. We had 2176, and then multiple offers on many properties, and then low inventory, 1.4 to 2 months of inventory by the end of the year. We ended up with 2.7 months of inventory. So a little more inventory than I was expecting, but obviously the market did a lot better than some of my projections. So let's see how it's going to look here for 2023 with some of my projections. Single family home sales, I do think they're going to drop a little bit more to about 90,000. So that's a continued drop about 5%. Total property sales, 107,000. Let's be drop about 8%. Single family sales price about 410 for the year. And it's going to be the average for the year is to drop about 1% for pricing. So I do think it's going to stay about the same. It could be up in some areas, could be lower in some areas. So I think it should average out to about where we were this past year. And then the rental prices, I think we'll probably end up around 2,100, which is drop about 4.5%. So yeah, that's kind of the projections here for this year. And then I think it's good too to kind of compare, like, hey, how does this increased interest rates really impacting the buyer right now? So in 2021, if you bought a $400,000 home at a 3.12% interest rate with 10% down, your monthly payment, just principal, was $1,541, and principal and interest. That doesn't include PMI, taxes, insurance, or anything. Insurance has definitely gone up since then. Here in 2022, if you bought that same house with an interest rate of 6.27%, you'd be looking at a $2,221 per month payment. So that's an increase of about $680 for that same home as compared to 2021. Now, we also did see prices increase about 10% year over year. So that same house for $400,000, you're actually kind of buying that for $440,000, which would be a monthly payment of $2,443, which is an increase of $902 per month. So that's definitely, a big increase for the same home. Again, kind of reiterating back to my point that homes are becoming less affordable. The affordability index is just too high. The homes are not very affordable right now based on interest rates and pricing. And then so if you look at the average sales price here for the Houston area by month, you just kind of see it just grown, substantially over the past 2-3 years. Now, if you were to take the lowest of the low here in January of 2019 at 277,000 and the peak in May of 2022 at 438,000, the percent increase would be 58% increase in just a 2.5 year span, which is just crazy. Now, obviously that's the trough to the peak, but still it's a big change of for Houston, where we're just kind of more slow and steady, 2 to 5% appreciation year over year. Just it's good, slow and steady, but we don't see this kind of appreciation. So one nice thing about the Houston area is that we just build a ton of new homes. These are some of the areas with the most permits pulled for new homes being built. As you can see, Houston in the Dallas-Fort Worth area is just kind of the top area for the last couple years, followed by Phoenix and Charlotte and Austin. So yeah, Houston is in a good spot. We're definitely going to have more properties and people coming here to snatch up. So I definitely think that these prices will start to slowly come down. And this next slide will kind of prove that. So very similar to the national new and resale supply. You'll see here, this is the Texas new and existing inventory. The blue line is the new construction and the red line is the resale. So as inventory obviously increases for months of inventory, we'll start to see prices come down and new homes will be a little bit more affordable. And here's monthly rent index for the major metro areas in the Texas area. As you can see, Dallas and Austin just went crazy, and San Antonio and Houston a little more slow and steady price appreciation over the last, let's see, about a decade. So yeah, so we were definitely peaked, and I think we're coming back down. Prices are going to kind of adjust, and so we'll kind of see how that goes this past next year. I do think they'll just kind of come down a little bit slightly, as I mentioned in my projections. So that's definitely remains to be seen with all the higher interest rates. So should you buy or sell a home here in 2023? I don't know why I have 2022 on the screen, but 2023. So guess I forgot to change that. So buy, maybe, a couple factors to kind of consider is, how long do you plan to be in this house? So if you're here for a short term, no one knows if this is the kind of the peak of the market. We definitely know we've peaked and come down a little bit. Are we kind of continue going back down? Are we going to go back up? Who knows? But I do think they'll tend to stay around this price, hover up a little bit, hover down until we find a nice little plateau. So, you may not be building, 57% of equity in the next 2.5 years. So it's kind of good to have a long-term outlook of your next home. So that gives you the opportunity to ride out any pullback or changes in the market. And then obviously, right now, if you were to buy, you're going to have less purchasing power. As I mentioned in the comparison of a $400,000 home in 2021 versus 2022, obviously interest rates go up, your purchasing power is going down. So you have to pay more for the same house. So yeah, if you can afford the higher cost and so forth, then yes, absolutely go for it. Now, if you are considering selling, then yes, absolutely. It's still a seller's market. It's not as insane as it was last year where you're getting multiple offers within hours of hitting the market, but there's still a good amount of buyers out there. There's still low inventory. It's still a good time to sell a house. We're close to near all-time high prices and again, very low inventory. And if interest rates continue to rise, prices will come down as more inventory kind of comes on the market and sits around is kind of what my expectation could be if we continue to have more homes hit the market. So again, also have to consider, okay, if you sell your house, great, where are you going to go? Obviously renting, maybe a little bit less competitive market, or you can just afford the higher prices of homes right now and interest rates. So great to sell your house, but figure out what the exit strategy is, where you're going, and what your new home is going to look like. So yeah, there's kind of some things to think about here for the Houston area. I definitely think we'll be in a strong seller's market. Some areas are just going to be super hot. Some areas are going to see more inventory kind of sitting around, prices start to come down. So it's really definitely be area dependent. A lot of my buyers that I'm working with that are purchasing new homes, particularly out in Katy, I'm seeing a lot of negotiation power. As I mentioned earlier, a lot of these builders are sitting on too much inventory, so they are being more negotiable with their pricing, with incentives, with the interest rates they're able to buy down. Some of these homes I've seen, builders drop $150,000 from their list price. So they're trying to get rid of some of this inventory. So definitely don't, if it's a little bit above the budget, feel free to kind of negotiate a little bit, especially if it's been on the market a little while. So with resale, you just have to be a little more patient. We are seeing the price to sales ratio come down. For a while, it was actually above like 100. You list a home at $400,000, it'd sell for $405 or $410 or whatever. Now homes are selling for within 3 to 4% of their list price. So you're having some wiggle room, but it's not, 50, 60, 100,000 off the sales price. Just kind of keep that in mind. So when you are out there making offers, considering, not offending the seller too much, but still wanting a good deal. So those are all great things to think about. And if you'd like some help with your next move, feel free to reach out. My information here is on the screen. You also can just shoot me a quick message if needed. So I really appreciate the time of watching this video. Please, again, remember to subscribe. I really appreciate it. It helps me out a lot. And if you have any questions or need help with anything real estate related, feel free to reach out. Thank you so much. All the best to you.